Testing. All right, everybody, we're going to be getting started in a couple of minutes. If you can come and find your seat. If you can't find your seat, find someone else's. If you can't find someone else's, look harder. He's here. Oh, sitting right there. All right, good afternoon, everybody. How about that lunch? Wasn't that great? Yes. It was actually really great. I was just being a little facetious there. Since you guys are in the room nice and early, you're going to get a big benefit versus the people who are going to be a little later. One of our sponsors for this event this year and last year is Indochino. So they make custom suits that look like this. And they make the custom suits look like the one you saw me in last year. They also make custom suits like the one Felicia is wearing over there. Making women's suits is new to them. They've been doing it now for a couple years. And Felicia's suit, I think, looks really awesome. She's got cool little oranges inside, and it looks awesome. What they are graciously doing for us today is giving away a custom suit to somebody in the room or at home if you're watching virtually. So the way that you enter is you go to the Indochino booth before 3 o'clock. So you've got 2 hours to get from here to there. They've got 3 people there. When you get there, they're going to take your information and they're going to do a draw after 3 o'clock, and we're going to announce the winner before we leave today. If you're doing it online, go to the Indochino booth through the online app and do everything that I just said to the people that are in the room. Same. And the lucky winner will be announced at the end of the day. You've got until 3 p.m. to visit the booth and talk to them. The guy specifically who measured me up, who was awesome actually, his name is Jatin, and he's there. They have a location in Yaletown on Homer Street, and they have a location at Metrotown. Both are good. The one that I got was Jatin at Metrotown. He was great. If anybody has seen Donna Thorne from PPI, she's here somewhere. She won last year, and she's got really good things to say. And then she said, because I went there to get a suit, my husband also ended up buying a bunch of stuff. And if anyone's looking for corporate gifts, an $80 custom shirt gift certificate fits under most people's allowable budgets of $100 or $200. So you don't have to give people $1,000 suits, but you can give them a shirt and then they can go buy the rest. So also want to shout out the Paradox Hotel. It's a relatively new hotel. It used to have a different name. And they've been great to work with. Actually, they've given us a significant discount this year because we were I think we were their first large event from when it became Paradox last year. And they do appreciate that you always remember your first, and they appreciate the loyalty of coming back. So please do enjoy the facilities. There's a spa, there's a nightclub, there's a lounge. I know we have a cocktail party happening here later. And last year, some of the people enjoyed the cocktail party so much that the staff said, hey, guys, we love that you love us, but could you please leave? Because it is well past our time. So what did they do? They went to the lounge downstairs and continued because the lounge is open. It's called Karma. It's in the lobby. And some of our guests were here from 7 in the morning until 1 in the morning, which is an attestation to the fact that they make nice cocktails here. Another great community sponsor that we've got is MyFO. So that stands for My Family Office. This is a new app that is launching right now. You can get on the beta test. I've actually seen on the inside, it's actually super cool. They revolutionize how investment and estate documents are managed. So the person who's putting this together used to actually run like a really large, like real family office. And so she's now said, other people should have this same type of service and the same access. So it's got an advanced AI that brings that family office service, offers real-time asset tracking, secure document storage, a consolidated management view of all of your different stuff. So if you want to see how much is in your investments, plus your insurance, plus your real estate, plus your business, plus your this, plus your this, plus your this, there's not really anything where it consolidates all of that. Now there's my family office. It's myfo.tech, myfo.tech. If you want to see it, you can also go to them through the app. They have like an online sponsor booth where you can go and talk to them. They'll give you a code that you can go and log in and be a beta tester and see what it looks like on the inside. The people in the back making this all happen, Pretty Screen Works. All you people that are watching online, this is all because of Clark's Audio Visual. We used them last year and we're using them again this year. They've done a great job. The microphones work, the screens work, this microphone works, the music works, all of the stuff. When you just need things to work and you don't want to run around and be like, why does this technology not work? Call Clark's AV. They can do your presentations here. They can do your presentations elsewhere if you're doing other types of parties and you need speakers or you need somebody to run the whole thing. These two on our side, and I think there's 3 or 4 on the other side. They've done a great job for us. We've been working with them through this whole event. Talk to Clark's. And then West Coast Actuaries. So a lot of us have and sell insurance policies, and sometimes you need to know what are these things worth more than just how much is the premium. So when you do need to know that, West Coast Actuaries can give you, can tell you kind of how much these things are worth when you need to value an insurance policy. So we are coming up on, oh, I've still got a ton of time. What should I talk about here? How about those Canucks? No, we're going to be coming up on Stephen McLeod from Canada Life, who's going to be talking about charitable giving strategies using life insurance. If you want, you can talk to your buddy next to you a little bit, or if you want, Stephen, we can get started maybe a couple minutes early and then we can let people out a couple minutes early. For the regulators, it will still be a full 60 minutes for the CE credits. We're just starting early and ending early. We're not only ending early, just to be clear. So if we want to start, maybe we'll put the code up for the next presentation. Are you all mic'd up, Stephen? I know that we're a little bit early. Yeah, and it works?
You got it on? Yeah, okay, I guess it does.
Is this on?
Yeah.
All right. And your code is OHEXA. This one doesn't have a number.
Is that a 0 or an O?
That looks like an O.
Okay.
I'll take a picture of that and do that when I'm off the stage. Has everybody been doing okay with being able to enter these in? Is it like, you know, in the first little bit it didn't work, but now is it working? Well, when you enter it and you hit submit, does it? Perfect,
then it works.
Yeah. No news is good news. Right, so we don't have to check out. Oh, right, yes, sorry, yes. But don't press that before an hour, because it'll say that you weren't here for X amount of minutes. And the way that CE credits work, it doesn't matter if the content is great, it matters that the content lasted 60 minutes. So you could have a terrible presentation, but as long as you make it take up 60 minutes, you could get a CE credit, or you could have an amazing presentation, and if it only fills up 45 minutes, you don't get a CE credit. You know, bureaucrat's gonna bureaucrat. So, Stephen McLeod, he's got all the letters after his name. He knows what he's doing. You can read the full bio in the program. But what you really want to know is what was his #1 best ever Halloween costume. Goose from Top Gun. The original Top Gun, not Top Gun Maverick, because there was no Goose in Top Gun Maverick. Which means that he is a fun-loving, optimistic, and loyal. Goose is the most loyal wingman a guy could have, inside and outside the cockpit. When he's in the air, he's always cheering on Maverick with phrases like, turn and burn, and go get him. While Goose is a blast to be around, he's also serious about his work, and he never misses a chance to outdo himself. Stephen.
Thank you.
Please outdo yourself.
Thank you.
All right, Goose.
All right. Yeah, and it was Goose. I was in a flight suit, not the Hawaiian shirt. So there's probably two versions of Goose in your mind. So yeah, I was in the flight suit with the fake mustache. Right. So, in terms of the code, I'm pretty sure if it doesn't say anything, you're good. Because the last one I mixed up the 0 with a O, and it didn't let me go. So yeah, so if it doesn't say anything, I'm pretty sure you're good. So anyways, so let's get on with the presentation. Charitable giving strategies using life insurance. So this is a topic. It's kind of timely for Canada Life. We do have a new product that just focuses on charitable giving. It's for that charitable giving space. I will touch on that a bit. But also there's that new tax rule, AMT, alternative minimum tax. And there's been a ton of headlines, probably, I've seen like from Investment Executive, advisor.ca, insurance portal. So like all these emails that you guys probably get too, there's always headlines about AMT, how's that going to affect charitable giving? So I'm definitely going to touch on that as well and give you my 2 cents on whether or not it is a big deal or not for charitable giving. So yeah, so we'll get there. Alrighty. Right, important considerations, just flew through that. So just a little bit of an outline of what I'm going to talk about today. So we're just going to go through some of the kind of more finer technical points about the tax incentives that are available for people to donate. So as it relates to people and corporations. So we'll kind of go through kind of the charitable giving 101 on that. That will have the AMT discussion. And then we're going to talk about 4 charitable giving strategies. The first one is transferring a policy to a charity. So we're going to go over the tax consequences of that, go through a little example. And then we're going to have a charity-owned policy. So that's where I'm going to talk about our new My Par gift, because that type of policy is only available to be owned by charities. Then we're going to look at a client-owned policy where we're going to do charitable giving by beneficiary designation. And then the last one, and this is one that I've talked a fair amount about this in the past couple of years, is how to do charitable giving with a corporate-owned life insurance policy, because there is quite a bit of nuance to that. Because you can't just have a corporate-owned policy that pays a dividend to the estate after death, and then the estate just donates the cash. You can get a donation tax credit that way, but you can't apply it back to the terminal return. So I just want to make sure everyone is aware of that. Because it's everyone misses it. It's a big rule that everyone misses. So I just want to make sure that we're all aware of that. All right, so moving on to kind of the charitable giving and tax incentives to donate. So just kind of starting with that. Here's the latest statistics from StatsCan, and this is from I guess information that came out from the CRA. It basically shows that charitable giving is alive and well in Canada. So Canadians, a lot of them donate to charity. So you'll see, we have almost 5 million donors as it relates to our tax filings anyways. Approximately $12 billion is donated. The median, so the average donation is $360, which is actually quite a bit. It's a little bit more than I thought it would be. And there's a statistic from 2020. It didn't make it into the 2021 statistics that came out this year, but I thought it was kind of interesting is that individuals with more than $150,000 of income, which represent 10% of the donors, account for over 40% of the donations. So probably, as everyone can expect, the more money you make, the more people are going to donate. So definitely. So basically, the point is that donating is alive and well in Canada. Now, there are various tax incentives available to people for donating. One obviously is the donation tax credit available to individuals, and that reduces taxes payable. When we're looking at corporations, there's a deduction available to corporations, which reduces income. Okay. And then there's a 0% inclusion rate for capital gains on gifts of certain types of property to charities. So that's could be mutual funds, so units or shares, an interest in a segregated fund. So with a segregated fund, you have to actually donate the entire contract to make yourself available for this benefit. So you can't just do like a portion of it. Just bear that in mind. So like bonds, ecologically sensitive land, and shares on that are publicly listed shares, basically. So 0% inclusion rate. So individuals. So let's just go over some of those incentives in a little bit more detail. So there, like I said, there's a donation tax credit available to individuals that reduces taxes payable. Now, when we're looking at how much is this tax credit worth, there's basically 3 tiers. So, and that depends on how much you make and how much you donate. So, your first $200, you're going to get, it's roughly about 20% on a combined federal and provincial basis of what your donation tax credit rate would be. So I think in BC, that's slightly over 20%. And then there's the second tier. So basically, any income level, but the value of the donation tax credit rate is, I believe in BC, it's 49.8% on that second tier. And then on the third tier, so that's if, again, in BC, if you make over $240,000, almost $241,000, if you're in that category and you make a donation over $200, then your donation tax credit rate is 53.5%. So now that information, it's kind of weird. It's really hard to get. So if you guys go online and you're looking at, well, what's the value of a donation, and you go on one of those online donation tax calculators, for some reason they're all the same, but they all top out at that second level. So they all, they typically don't go to that higher level, but just know that that there is 3 tiers, and the higher one is often left out on those donation tax calculators. The maximum donation that you can use for using a tax credit in a particular year, it caps out at 75% of your net income, and that applies to corporations as well. And then if you have any unused donation tax credits, you can carry them forward for 5 years. If you donate by a will, by a will or through a will, and this is very similar to donating by beneficiary designation, which we'll get to, that donation is considered to be made by your estate. If your estate is a graduated rate estate, so if it's a testamentary trust that's designated as a graduated rate estate, you can actually take that donation tax credit and carry it back to the terminal return. Okay, if it's not a GRE, you can't do that. There's a little bit more flexibility too. So the donation tax credit isn't limited to 75% of net income in the year. And I'm talking about the terminal return, so that goes up to 100%. So that's in the year of death and the year before death, so the preceding year. As that donation tax credit relates to a GRE, again, it is capped to 75% of net income in the year. There is a 5-year carry forward, and you do have 5 years to make that donation as long as the estate otherwise looks like a GRE. So GREs typically end at 3 years. But if it's still, like, for example, a testamentary trust going past that 3-year period, there's still 2 extra years where you can make the donation. Like I said, for corporations, there's not a donation tax credit, there's a deduction. Okay. So, and also there's that 75% of net income limitation with the 5-year carry forward. Okay, so that was kind of the nuts and bolts of taxation of charitable donations and how donation tax credits, kind of in a nutshell, how they can apply. So now let's look at AMT. So AMT, it's been in the news quite a bit, your financial news rather. And basically what is AMT? So it's kind of a parallel tax regime that's contained in the Income Tax Act. So basically you have your regular tax, and that's basically what everyone's familiar with. So you calculate income one way, you have tax credits that can reduce your regular tax payable. But along with that, there's this parallel tax regime called the alternative minimum tax. So the alternative minimum tax has its own way of calculating income, so what it includes in income. And then it has its own way of looking at various tax credits that can reduce the amount of AMT payable. So once you do those 2 calculations, you look at, okay, what tax liability is higher? Is it regular income tax or is it alternative minimum tax? And if the AMT is higher, then you pay the difference between that higher amount and your regular tax. So that's basically the AMT that you're paying. And if you have to pay that, it's not necessarily the end of the world. It's not necessarily a sunk cost, because you could use that as a credit for future years against regular income tax, provided that regular income tax is higher than AMT in that year. And there's a 7-year carry forward as well. Okay. And AMT does not apply in the year of death. So that's very important for us to know, because estate planning is kind of our bread and butter, kind of our space. So it doesn't apply in the year of death, and the AMT amendments, which I'm going to talk about, they don't apply to GREs as well. So that's a nice feature as well. So that's AMT. So this year in the 2003 federal budget, basically the government introduced a new set of rules that will basically beef up AMT. And those rules, it was proposed in the spring with a budget. Draft legislation came out at the beginning of August. And it looks like, well, typically what happens is that after that draft legislation is introduced, it's probably the case that AMT kind of, as we see it in its substantial form, will probably get enacted into law, and that will be applicable in 2024. So basically, currently for individuals, 2023 taxation year, the new AMT rules won't apply. 2024, they will. So if we want to do a little bit of planning around that, which we'll talk about, there's kind of a short window to do it. But kind of an argument that I'll make, and I don't know if this is shared by a lot of tax professionals, is that I think a lot of high income earners don't necessarily have a run out right now and kind of go do a significant charitable gift if they want to. But high income earners that earn a lot of low rate income, like capital gains, like you mentioned capital gain strips on the last presentation. So if you have a taxpayer who does a lot of capital gain strips and all they have is capital gains in terms of their income, and they want to make a significant charitable gift, yes, they should probably go out and do that before 2024. And I'll show some numbers about that. So looking at some notable changes to AMT, what are they? So here's the table here. I basically show kind of the highlights on the AMT changes as it relates to regular tax, the existing AMT regime, and then on the last column there that's highlighted in red, that's the new AMT. So you can see at the rate. So the current AMT rate is 15%. That's going up to 20.5%. The AMT exemption, so the amount of income calculated for AMT purposes is currently $40,000. That's going to go up to $173,000. So we're really pushing the application of AMT into a higher income level with that exemption. The capital gains inclusion rate, this is a big one. So currently, so as everyone knows, for regular taxes, it's 50%. Under the current AMT regime, it's 80%. That's going to go up to 100%. Capital gains and inclusion rate on donated public securities. So like I said before on a prior slide, the capital gains inclusion rate is 0%. Under the current AMT regime, it's also 0%, but it's going to be 30% under the new AMT regime. Non-refundable tax credits, so including the donation tax credit. So when we're looking at the current AMT regime, it's just like regular tax. We can use the full amount as a tax credit against AMT payable, but that's going to be cut in half under the new AMT regime to 50%. So when you look at those two features about donating public securities, that capital gain, if you have any, when you do that, because when you make a gift, it's a deemed disposition at fair market value, you could have a capital gain. So 30% of that capital gain is included for AMT purposes, but so that's increasing your AMT income, but your AMT payable, it's not getting reduced as much by the gift that you're giving to charity. So right now, you can use your full donation tax credit for your current AMT, but that's going to be cut in half next year. And the last point there, that doesn't apply. I mean, that's not really in the charitable space, but I thought it was interesting because a lot of us talk about leveraged investing or perhaps the IFA if we're using IFA loan for property income. So if we're looking at interest deductibility on loans used to earn property income, that deduction is also getting reduced to 50% as well. So currently it can reduce AMT income on a 100% basis, but that's getting reduced under the new AMT regime as well to 50%. All right, so let's look at a handful of examples here just to see kind of what kind of impact AMT will have for people who high income earners basically who are making significant donations. So this slide here is a very popular example. So I've read a lot of articles as they come out on the new AMT regime and how it impacts. This is like a really common example that I've seen, and I just want to highlight it for you and just kind of show you how the new AMT regime could apply. So let's say we have someone that has a $2 million capital gain in a year, and they want to make a significant donation. So basically, we're gonna go up to the maximum, so 75% of net income. So because half of a capital gain is included in income, so the gift is going to be $750,000. So maybe for the interest of time, instead of going through all these rows, if you just jump to the bottom, you'll basically see that the tax payable. So under regular tax, so someone has $2 million capital gain, half is included in income. If they make a $750,000 donation, they're going to have significant tax savings from the donation tax credit. They're only going to have $115,000 in change of regular tax on that. But under the new AMT regime, so you can kind of see how this impacts capital gains. You'll see that, on the second line, the amount of AMT income is, with the $173,000 exemption, it's a little over 1.8 million. Okay, so that's your AMT income. So that's what we're calculating that 20.5% tax rate against. And then you'll see the tax credits from the donation. You'll see that under the regular tax, we're saving around $334,000. Under the AMT regime, we're only saving about $187,000. Okay. So at the end of the day, regular tax, we have $115,000 in change. Under the new AMT regime, we have $383,000 in change. So remember where I said you're paying the higher of either. So basically you're paying $268,000, $268,000 in change of AMT. So that's quite a bit, right? So like if you're going to show an example, like this is, if this is your client who just has a very large capital gain in a year, and they're going to make a very large donation, then yes, by all means, go out there, talk to your client, make sure they do it this year, because they're going to have a very significant AMT liability. This might be tempered a bit if in the following year they're going to have more high rate income that they can use that AMT credit against. But if this is your client, by all means, AMT will be very impactful. This example, it kind of, I don't know, for my point of view, it's kind of cherry picking to some degree. Like, for example, if I was going to have a $2 million capital gain, if I don't have any other income, I'm probably not going to give away $750,000 because it's quite a bit of money off your capital gains. So if someone is actually doing this, I got to think that they've got a bunch of other income sources, or sources of income rather, that they have other high rate income. So that impact of AMT isn't quite as impactful. But like I said, if this is your client that has a lot of capital gains and they want to do a big donation, AMT will definitely impact them. So let's look at more higher rate income. So that was someone with a capital gain. Let's look at someone who has a mix of salary and dividends, okay? And they also make a significant capital gain. So again, in the interest of time, I won't go through each line, but if you just look at the bottom row, you're going to see that under regular tax in this scenario where we have $200,000 of salary, $300,000 of non-eligible dividends, and a $250,000 donation, the regular tax is going to be roughly $32,000 more than the AMT. So we're not paying AMT in this scenario. Okay, so this is higher rate income, still a significant donation, no AMT next year. If you say, okay, well, let's give this person more income. Okay, so let's double it. So if we have $400,000 of salary, $600,000 of non-eligible dividends, and a $500,000 donation, so again, a big donation. Still, if you look at the bottom line, $205,000 of regular income tax, $133,000 of AMT. So we're not paying AMT in this situation. So we have a high income earner, a big donation, no AMT. So if you're saying, okay, well, let's bring this up to the maximum. Let's bring it up to 75% of net income, kind of with that same high rate mix. So what do we have here? So in that case, we have, if you go down to the bottom line, you'll see that the regular tax is in fact smaller than your AMT. So yeah, you are paying AMT if you, in this particular scenario where you have someone with high rate income, so there's a mix of salary and dividend, and they're making a substantial donation, there's still some AMT. I forgot to mention, so the rates that I'm using are Ontario, which are very similar to BC. For example, in Ontario, the combined AMT rate, federal, provincial, is 33%, or about 33%. In BC, it's a little over 32%. So kind of my conclusions are basically applicable in BC, just because the rates are so close. And just based on, it's kind of interesting too, when you look at the combined federal and provincial AMT rate of 32%, then it really kind of hits home that, yeah, that is higher than the combined federal provincial rate on capital gains of 26.75. So then that, yeah, someone who has a lot of capital gains in a year, they're good, like AMT is definitely going to be an issue. Yeah, so kind of having that combined rate it makes it a lot easier to conceptualize. So yeah, so basically, yeah, you do have AMT in this situation, but I just want to kind of bear in mind, if you have this high rate income in this year, you're let's assume that you're going to have this high rate income in the following year as well. And if you only have $54,000 of AMT credits that you have to use up, then that's very easy to do if you have this high rate income in the following year and you're not making a very substantial donation. So, so when you see, so basically my point to you when I'm submitting to everyone is that, yes, there are lots of lots of talk in the tax world about AMT and charitable donations and how you really have to look at it. I think you do, but whether or not it's critical or not to act really depends on the client and what kind of income they earn. If it's low rate income, yes, act. If it's high rate income, it's not so critical. So if we can draw some conclusions based on that. So clients who earn a lot of capital gains, AMT will impact them. Clients who have a lot of capital gains and want to make a significant donation, AMT will definitely impact them. You want to act in 2023. You want to make that donation this year, not the following year. Clients earning higher rate income who make cash donations, AMT probably won't impact them that much. And if it does, they'll be able to use the credits quickly in the following year. And then clients who have higher rate income and who are donating public securities that have a big accrued gain, they'll probably want to consider making a donation this year more so than next year. But like I said, if they have high rate income and they're going to continue the next year to have high rate income, the AMT is more of a nuisance because they're going to be able to use those credits in the following year. I don't want to sound like I'm defending AMT because I'm not. The last thing the Income Tax Act needs is a few more pages, which these rules do add to it. But I'm just saying it's very specific whether or not this is really going to impact a client. If they have a lot of low rate income, it will. If they have high rate income, not so much. Okay. So any questions about AMT before I move on to talk about some strategies? No? Okay. All right, let's move on to charitable giving strategies. So basically, when you think of charitable giving strategies, there's really two buckets. There's one where the client owns the policy, the life insurance policy. And then the other one is when the charity owns the life insurance policy. Now, if the client owns the life insurance policy, the tax benefits that the client will get as a result of making the donation with life insurance will occur at death. And it will probably be larger than it is during life because we're looking at the death benefit, and I'll get to that in terms of when we're looking at how to calculate the donation tax credit. If they have it, if the client owns the life insurance, or sorry, if the charity owns a life insurance policy, and say the client is then making premium payments on that, or has transferred the policy to the charity, then really we're just looking at tax benefits that occur during the client's lifetime, and that relates to the premium and the donation of the charity. And we'll go through some numbers on that. But those are kind of the two ways of looking at it. Does the charity own it? If so, the client gets tax benefits during their life. Does the client own it? If so, the client will get tax benefits on death. And they'll probably be a lot larger because it'll be based on the death benefit. Okay, so that's kind of the two buckets, and then the strategies kind of spin off from that. So the first one we'll look at is when a client has already owns a life insurance policy individually, and they are going to transfer that to a charity and then keep paying premiums on that. So here's a little schematic about what's going to happen. The donor, so the client, gifts the policy to the charity. Let's assume that there's continually premiums that are payable on that policy. So the client is going to either pay the insurer on behalf of the charity. You can still get a donation tax credit that way, or just make the donation directly to the charity and the charity can pay the premium. Okay. And then basically, like I said, there's going to be two tax benefits as a result of doing that, where you can get a donation tax credit, one on the premium payment, second on the donation of the policy. And there's some rules around that, which we'll discuss very soon. And then on death, in this case here, that the charity will get the death benefit. Okay. So the benefits of this is that the donor receives a donation tax credit each year that premiums are paid, and on the transfer of the charity has access to the cash value of the policy if it has any, so they're able to get a bit of liquidity on that if they need it during the lifetime. The ownership by the charity provides it with greater assurance that it's actually going to benefit from it. Considerations is that the charity controls the policy, so if the client changes their mind, they can't really go back and get that policy back and give it to another charity if they want. So they're kind of locked in after that point. The policy administration by the charity. So charities, that's a bit of a pain point with charities owning life insurance is that sometimes they struggle with administering and just making sure that premiums get paid or just kind of dealing with variable interest options if they need to, or policy changes because they're not necessarily used to it. So that is a bit of a pain point with charities. So it is a consideration. I guess, the flip side is that they control the policy. On the other side of the coin, then they have to administer it. And then the last thing, there's no tax credit when the death benefit is paid to the charity. So like I said, the only tax credit is involved is on the premium payment and on the transfer. Now, let's talk a bit about that transfer. Whenever you gift a piece of property or property to a charity, it's a disposition at fair market value. Okay, if the fair market value exceeds the adjusted cost base, there's a capital gain. In the life insurance world, it's the exact same thing. So when you gift a life insurance policy to a charity, basically it's a disposition for tax purposes. The proceeds are going to be the higher of consideration, ACV and CSV. Okay, now since it's a gift, there's no consideration, right? So we're looking at the CSV usually, and if the CSV is higher than the ACV, then there's a policy gain. Okay, now, so that's the policy gain for the donor. Now, when we're looking at the donation tax credit, so what kind of donation tax credit can the donor get when they give that policy to a charity? There's a couple of deeming rules that you really need to work through. So it's going to be the lesser of fair market value and of the life insurance policy, and you need to go see an actuary, I guess like West Coast actuaries. They'll do a valuation of the policy to tell you what the fair market value of the policy is. So it's going to be the lesser of fair market value and the adjusted cost basis of the policy. If the policy is donated within 3 years of acquisition, or the policy was acquired with the intent of donating to charity within a 10-year period. Okay, so if you just get the policy with no intention of donating, but you do it within 3 years, the donation tax credit is the lesser of FMV and ACB of the policy. If you get the policy with the intention to donate, and you do that and you donate within 10 years, then again, the donation tax credit is the lesser of fair market value in ACB. If you're past that 10-year period, then it's fair market value. Okay, just kind of with no questions asked. So let's just go through an example of what that could look like. So let's look at a donor age 60. They have a $250,000 UL policy, or a UL policy with $250,000 of coverage. It was issued 20 years ago. So just by virtue of that, we're past those two deeming rules, so we're not going to deal with that. The donor no longer needs coverage, and let's just assume a 50% donation tax credit rate. The annual premium is $2,500 per year, nominal cash value. So basically, when we're looking at when we donate the policy into the charity, there's not going to be a big policy gain that we have to deal with. The policy's adjusted cost base is $40,000, so the policy gain is zero. The fair market value of the policy is $50,000. So we went to the actuary, we got the valuation. We paid, say $1,000 to $1,500, however much it costs to get a valuation. They tell us it's $50,000. The tax benefit on the donation, given our 50% donation tax credit rate, is $25,000. And every year that we pay a premium, either to the insurer on behalf of the charity or directly to the charity, and they can look after paying the premium, the tax benefit on that is going to be $1,250. And then the death benefit at life expectancy is $250,000. So this is kind of basically the tax benefit that you're looking at in this scenario, where someone donates a policy to a charity, and then they have to keep paying premiums going forward. Okay, so that's our first scenario of a charity-owned, first strategy where we have a charity-owned life insurance policy. Now, the second strategy we're going to look at is when we're going to look at our new product, our new MyPar-Gift product. Has everyone heard of that? Canada Life's new MyPar-Gift. There's some nods. Okay, we got one glass of water in the air. Okay, okay, good. All right. Okay, so in this one, the charity is going to own the policy just from issue. Okay, so it's not going to go it's not going to go to a donor and then to the charity. It's going to be issued to the charity directly. Now, if you're dealing with traditional life insurance products, and when I mean by traditional, I mean like not MyPar-Gift, which I'll get into in a little bit more detail. But there's always been that underwriting challenge by having a charity get the policy from issue, because there's the insurable interest issue, right? Where the insurer will ask, okay, well, Charity, what's your loss if this particular life insured passes away? Okay, that's always been a sticking point. And then there's the other sticking point where sometimes charities aren't exactly gung-ho about trying to administer a life insurance policy, because it's kind of an asset that they're not really used to dealing with. So that's where our My Part gift really came in to kind of alleviate those two pain points. So basically, with My Part gift, to get around the underwriting challenge, we just looked at the donation to the charity to pay the premium as basically the evidence of the life insured's kind of relationship with that charity to get around the underwriting issue, right? And I'll get into a little bit more detail about My Part gift, because it's just a one-pay par policy. It's basically one and done. So there's no administration. It's a par policy, so you don't have to worry about the investments and the variable interest options and the account value. So it really does alleviate those two points. A lot of words on this slide, which are kind of duplicated on this slide. So I'm just going to go here. So let's just talk about, I'm just going to give a brief intro to My Part gift for those of you who aren't familiar with it. Like I said, it's a one and done life insurance policy. It is a participating whole life policy. We only allow a charity to own it, principally because it is a one-pay par policy, so it is not tax exempt. It is a non-tax exempt life insurance policy, but because a charity does not pay tax, they don't care. Okay, so and we only allow a charity to own it as well. So it's not like you can have a charity own it and then transfer it to an individual at some point in time. So it's just a charity-owned par policy. Now, the way it works is because the charity owns it, like I said, the tax benefits to the donor is just when they make that premium payment, and that's it. So they make that one premium payment, they'll get a donation tax credit based on that, and that's it. The death benefit will not give them any sort of benefit, donation tax credit to their estate on death. There's no ongoing policy administration, like I said, so that's beneficial. There's no risk of non-payment of premiums. So like I said, there's only one premium payment and it's done. The life insurance policy won't impact a charity's disbursement quota. So this is actually a really big benefit to a charity. And it applies to the previous example too, when the donor donates the policy to the charity. That policy won't impact the charity's disbursement quota either, but neither will this My Part gift policy. And it's really big because the disbursement quota basically makes a charity disperse, or basically pay out for charitable purposes, 5% of their assets that are not used in a charitable activity that exceeds $1 million. So this really applies to a larger charity. And it's actually now that interest rates are higher and a lot of their investment assets are doing a lot better at charities. So the impact of the disbursement quota isn't quite as big. But having a life insurance policy not actually make the charity pay out 5% of their assets not used in charitable activities is actually a really big benefit. So if you are positioning My Part gift or life insurance to a charity, make sure to raise that issue because it is something that is definitely very appealing when you compare that to other types of investments or financial products. Basic design elements. So it's a non-exempt participating life insurance policy, like I said. There's one cash value pattern. It kind of looks like Wealth Achiever a little bit. So it is kind of on the higher earlier side, which we'll see. The dividend options are paid up additions, enhanced coverage, but enhanced coverage with guarantee only or cash. It can be issued on a single or joint basis. The issue ages are 18 to 75. So a little bit younger compared to what our traditional par policies can issue to age 85. The product minimum is a $10,000 premium payment. It's a little bit scaled down compared to other par policies. So there's no riders or additional benefits, no ADO, although I don't know why you'd want ADO on this type of policy. Enhanced coverage, but like I said, only on the guaranteed basis, not the 10-year. And policy loans are available as well. And also charities can also assign the policy to a bank for a loan as well, for a collateral loan if they want liquidity from that cash value too. Okay. So let's just do a quick example with My Part gift, just so you can see some numbers around it. So let's just let's look at a 60-year-old a couple. They're both 60, Sam and Sonia. We're going to use a standard risk policy. They're non-smokers. They recently downsized their home, so they have some cash available, and they're wondering, and they're looking at doing something with it from a charitable perspective. They connect with you, they connect with their advisor. Your advisor kind of suggests using the MyPar gift. So we're going to look at what that looks like. So what kind of policy details are we going to have? So we're going to look at $100,000 single premium. It is a joint last to die basis. This gives them $155,000 of coverage, of basic coverage off the bat. We're going to use paid up additions as a dividend option so that the amount of coverage will grow over time. And what I'll illustrate is the 2023 dividend scale. Okay. So if we look at kind of a line graph on what this looks like, the bottom line is the cash value of the policy. The top line is the death benefit. You'll see at year 8 is the crossover. So the cash value equals $100,000 at year 8. And you'll see if we go out 30 years to age 90, the death benefit grows from 155,000 up to 424,000 and change, assuming the 2023 dividend scale. So the IRR is 4.9%. So pretty good cash value, definitely good cash value from this product. Good death benefit as well. So like I said, this kind of reminds me more of a wealth achiever, although there is, with MyPar gift, there only is one cash value pattern. So it looks a little bit more like an early cash value, but definitely good values with MyPar gift. Okay. All right, so let's move on to the third strategy, and that is donating by beneficiary designation. So here's a little schematic that shows what that looks like. So we have the donor making premium deposits into the life insurance policy. The donor owns the life insurance policy. The charity is the beneficiary of the death benefit. And on death, the charity gets the death benefit, and the donor's estate and the donor in the terminal return, assuming the estate's a GRE, will be able to get the donation tax credit, but it's based on the death benefit. Okay, so let's go over some tax rules about this. So the donor owns the life insurance policy, like I said. The charity is named as beneficiary. There's no donation tax credit when the premiums are paid. Upon death, the proceeds are paid directly to the charity via the beneficiary designation. Now, there's a flexible allocation of the donation tax credit, assuming that the estate designates itself as the graduated rate estate. So basically, the terminal return will be able to benefit from the donation tax credit the preceding year as well, and then the graduated rate estate will be able to benefit from any unused donation tax credits as well. So, like I said, the donation tax credit is available on a flexible basis, assuming that the estate is a GRE. One option or I guess one alternative that you see sometimes is that the estate is designated as the beneficiary of the life insurance policy, and then the estate makes the donation to the charity. So if you do that from a tax perspective, you come out to almost the same thing. Well, from an income tax perspective, you come out to the same result. So basically, the donation tax credit will be available to be in the GRE and also in the terminal return in the preceding year. The only downside to this is basically probate. So you're going to expose, there's going to be probate on the death benefit, and then you're going to expose the death benefit to creditors of the estate as well. And then also, I don't have this point on the slide, but there's also some drafting issues when charities are named as beneficiaries of a will. Because it kind of leaves the argument available for the CRA to say, you know what, that distribution from the estate to the charity is not a gift. That's a distribution to a beneficiary of the estate. So we're not going to consider that a gift for tax purposes. That will give you a donation tax credit. So that's why you got to be careful if you have a charity named in a will. A lot of times it will just give wills will give the power to the executor to make a donation. But there'll be like a letter of wishes or something that just tells you, you can make a donation to this particular charity, but it won't be named in the will, just to get around that issue of having it be looked at as a donation to a distribution to a beneficiary of the state rather than a gift. Okay. So benefits of gifting by beneficiary designation, it does allow for a substantial donation following death. And that can also lead to a substantial donation tax credit. So if there is a large tax liability at death, and you're looking at, we can have a charity-owned policy or a policy owned by the individual. Policy owned by the individual for tax for a tax planning purpose is definitely a better option because it does avail the donor to a larger donation tax credit at death. The donor controls the policy as well. So, I mean, if you want to change the beneficiary designation to another charity, that's always available as well. So that gives some flexibility. Considerations. We're looking at, because donating by a death benefit can give rise to such a large donation tax credit, we want to make sure, well, ideally that there's enough income in the estate or the terminal return to be able to use that donation tax credit. If you don't have enough income, you're kind of losing that donation tax credit because you can't like give that to a surviving spouse, unfortunately. It's kind of stuck. So you basically use it or lose it in the GRE or not. So if we go through an example of what this could look like, so again, we're going to look at a donor and their spouse, age 60. This time we're going to use one of our par policies, the Estate Achiever Plus, pay to 100. So it basically has contractual premiums till the equivalent single age is age 100. I think in this case for 60-year-olds it's about 110. So we're looking at $500,000 of total coverage. We're looking at the enhanced coverage lifetime guarantee, joint last to die basis, premiums payable to last death, and the charity is the beneficiary of the policy. And we're going to assume a 50% donation tax credit. So the annual premium is $8,400 and change. The aggregate premium, so over a 30-year period, we're looking at $252,000 and change going into the policy. At year 30, the death benefit has grown from $500,000 to $567,830 as the PUAs take over the enhanced coverage by that point. So the charity gets that amount, the full death benefit, and the tax savings from the donation tax credit is $283,915. So the tax savings are far more significant than if we're looking at personally owned, charity owned policies. Okay. So moving on from that, does anyone have any questions or comments before we move on? I am kind of motoring along because I do want to spend a bit more time on this corporate owned strategy than the personal ones. We're good? Okay. So let's look at a corporate owned life insurance policy and how we can use that for charitable giving. Because like I said, there is some nuance to that, just to make sure that we can have a donation tax credit that we can use in the terminal return. So not just in the graduated rate estate. Okay, so here's the setup. So we have the client own shares of the private corporation. At some point in time, this client has done an estate freeze. So the shares that they own have a fixed value. When you do that, when you do this strategy, they don't have to own free shares. You can have common shares, but just for the sake of the example, it's a lot easier to explain when the shares have a fixed value. So we're not kind of playing with the fair market value of shares when the corporation receives a death benefit and has more cash and then makes the donation. So this strategy works a lot better when the client owns fixed value shares, where we know the value of those shares. And it won't change no matter how big of a death benefit the corporation gets after death. Okay. So the client is working with her advisors on a succession plan, and part of this is decide what to do with the shares after death. And this particular client, as you'd expect, has a philanthropic interest. So here's a schematic or a corporate org chart of what we're looking at. We have the client owns preferred shares, they're in green. Let's assume that those shares have a $10 million fair market value, $1 adjusted cost base. So on death, there's going to be a $10 million capital gain. When we did the estate freeze, we used a family trust to own the common shares. The family trust at this point, or the common shares at this point, has a $2 million fair market value. So the corporation's worth $12 million. The corporation grew $2 million since they did the estate freeze. So this is the setup. The plan is that the corporation is going to purchase a life insurance policy with $5 million of coverage. The estate plan is revised so that 50% of the client's shares are going to be donated to the charity after death. And after the donation is made and after the corporation receives the death benefit, the corporation is going to buy those shares back from the charity. So a redemption. Okay. And then we're going to use the $5 million of life insurance to pay the redemption price for that. But we're not going to use the CDA because we don't have to worry about turning that redemption, which is a deemed dividend, into a tax-free dividend to the charity because they don't pay tax. So we can save that CDA. So in a little bit more detail, I'll kind of run through that again. So what happens when the client dies? The corporation is going to receive that $5 million death benefit on a tax-free basis. Let's just assume the ACB of the policy is nil. So the full amount of the death benefit is going to credit the capital dividend account for the purpose of the example. So a $5 million credit to the corporation's CDA. The estate is going to donate those $5 million worth of preferred shares over to the charity. The corporation is going to use the $5 million of life insurance proceeds to buy back those shares from the charity. For tax purposes, that is a deemed dividend. It's taxable, like I said. A charity doesn't pay tax, so it doesn't care that it's receiving a taxable dividend. So the corporation is not going to use the capital dividend account credit on that deemed dividend, like you might otherwise if it was like a lost carryback to the individual estate, but we're not doing that here. We're going to keep the CDA with the corporation, and the corporation can use that CDA for other non-insurance assets. And that's really the benefit of this strategy, okay? Like I could have, redeemed shares from the estate, got the insurance money into the estate. But to do that, like I said, that's a deemed dividend, it's taxable. I would have had to use CDA. But because the estate is transferring shares over to the charity and the redemption is being done at the charity level, I'm not using CDA. So just that little, that little step of doing it, of having the estate donate the shares instead of having the estate donate cash, we're saving all that CDA for other non-insurance assets. So it's a really great strategy. So if we look at the results on death, so we got a capital gain on the final return of $10 million, because remember the preferred shares were $10 million. That's going to result in $2.5 million of tax. We're making a $5 million donation. That's going to create a donation tax credit. That's going to save us $2.5 million of tax. So that takes out our tax liability at death. So we've done that planning. So we've taken care of the tax liability at death. The death benefit goes to the charity. Charity gets $5 million, and there's CDA left over in the corporation. So that's kind of the benefit of that strategy. Like I said, again, is that CDA left in the corporation. And I guess, of course, the donation tax credit looked after the capital gains tax liability on death too. But that extra CDA is really the kicker. So so just looking at a schematic after this, what does the corporate structure look like? Well, we have the estate now. It owns $5 million of shares. The ACB is $5 million because there was a deemed disposition at death. The corporation is still worth $12 million. So the common shares have went up in value by $5 million at this point in time, but the estate can distribute those preferred shares out to a kid or out to the next generation on a basically a tax-free basis at that point. And then the charity has $5 million of cash and the corporation has $5 million of CDA left over. Okay. Now, basically the reason why we did it that way really falls into a tax world. And this is kind of that point that I kind of highlighted at the beginning and that I want to make now, is that for a graduated rate estate to be able to make a donation that allows it to have a donation tax credit, then it can apply to the terminal return. So basically wipe out the client's taxes arising at death. So those arise in the terminal return. So in order to get that donation tax credit that can go back to the terminal return, it has to donate property that it received as a consequence of death. And that's like I'm quoting from the Income Tax Act there. So it has to be property received as a consequence of death or property that's substituted therefor. And a cash dividend paid on a share is not property. So that cash is not property that's received as a consequence of death, and it's not property that's substituted therefor. Okay. If the corporation redeems shares that are owned by the estate and pays cash for those as a redemption price, that is property that's substituted. So that cash payment for those shares that are redeemed, that cash is property that's substituted for property that was received as a consequence of death. So if you just had a corporate and life insurance policy, and I'm talking outside of the strategy that we just talked about right now, okay? I'm just talking generally about donating with life insurance, with a corporate and life insurance policy. If a company paid a cash dividend to the estate, whether it's capital dividend or taxable dividend, and then the estate donated that cash to a charity, the estate would get a donation tax credit, but it would be stuck in the estate. You could not take that donation tax credit and apply it back to the terminal return. That's why redeeming the shares and having the redemption price paid for with cash, the cash all of a sudden becomes substituted property. Then if that cash was then donated to a charity, that would give the estate a donation tax credit that it can apply to the terminal return. Okay. So very important point. It's amazing how often, if I'm reviewing a will of someone who's doing charitable giving with a corporate life insurance policy, that's missed. To be honest, I just figured that out about 3 years ago, that this applies, but it's a very nuanced point, very important for high net worth or business owners who are doing charitable giving and who have a corporate owned life insurance policy, because it's missed very often. So just so please remember that point when you're dealing with clients who are donating and have a corporate owned life insurance policy. And if we're dealing with private foundations, if you donate, so this is going back to the strategy, if you donate shares to a private foundation and it's shares of your company, let's do it in the context of an estate. If an estate donates shares of a private company that it controls, the donation tax credit doesn't arise on the donation. It arises when those shares are redeemed, basically when those shares are disposed of. So that's why, that strategy that we just went through, where basically the corporation redeems shares that are owned by a charity. In this case, it will be a charity that's a private foundation. That works really well when we're dealing with private foundations, because the donation tax credit will be available as soon as those shares are redeemed. And because life insurance provides not instant liquidity, but within 2 weeks to a month or so, that a corporation will have those funds to buy back those shares, and that will allow the estate to have the donation tax credit when they're bought back. Okay, another good tax point. So those are the strategies. We do have a lot of materials. So we have 4 articles on our tpgsalesstrategy.ca website that covers everything that I just talked about today, all the strategies, including my par gift and the insured share donation strategy. So we have that. We have resources for that. And that basically sums up, and that basically concludes the presentation. So I see we have about 3 minutes left on the prompter. I don't know if that's for me speaking or the whole hour. Or
We're going to ask some questions in those.
Oh, okay. Sorry,
Thank you
I
so much,
didn't have much
Steve.
time. Right. Thank you.
That was a technical presentation, so I'm sure, well, yes, there you go.
Okay.
I have a question. If a donor owns a policy and is named a charity as a beneficiary,
Yeah.
one of the concerns is that what if the beneficiary ceases to exist? Like if the charity winds up, what happens?
Okay, so I believe the answer to that is that the death benefit is paid to the estate. Yeah, I'm fairly certain that, because I'm fairly certain that it's the same thing, is that if the beneficiary doesn't exist anymore, then the death benefit gets paid to the estate.
Okay.
Yeah.
Okay.
Any other questions?
One in the back over here. And if anybody's watching us virtually, please put any questions in the chat for this specific session. And we've got somebody monitoring the chat that will read those questions out in person.
Thank you, Stephen. Actually, 3 questions. So first one, for my part, can the payer be different from the life insured? Because grandpa might have a lot of money and be aligned with his son, who would be more insurable. So that is something I'm really curious about. The second, can the beneficiary be a foundation like Vancouver Foundation in case the client wants to split it up between, say, 10 charities versus 1 charity? And third question, well, I don't know if you'll have time. I guess I can look it up myself, the disbursement quota thing. Thanks.
Okay, on the first question, well, like I said, to get around the underwriting issue, we need the person who's insured to make the to actually make the donation. So the payer needs to be the life insured. So I don't know, maybe grandpa can give money to whoever's going to be the insured. So yeah, basically the insured needs to be the payer as well. If we're, that kind of reminds me of a corporate context. We can have a corporation making the payment, but the life insurer needs to be a controlling shareholder of the corporation. And your other question was,
Can they split the beneficiaries?
oh, can you split the beneficiary? Well, yeah, so it's going to be a charity-owned policy. So the charity will be the beneficiary, and presumably if they want to split it between, like if it's a donor foundation with different options that are charities, then yeah, presumably I think they can.
Or would they just set up one for this one, one for this one, one for that one?
Different policies, I guess that's an option as well.
Makes
But
sense.
yeah, so I guess, to be honest, I haven't actually, I haven't really thought about, okay, whether or not a charity would own it and then want another entity to be a beneficiary. But in terms of that context where it's a donor advised fund and there might be different charities, I don't see why not, you know, based on our criteria. Any other questions?
Anybody online? Did we look? Oh, there's one online.
Is the capital gains inclusion rate for QSB capital gains remaining at 30% for AMT purposes?
Yes, it is. So yeah, so in the current AMT regime world, that's really the only time you really get into thinking about AMT. Well, maybe not the only, but that's kind of the main thing, is when someone exercises their capital gains exemption. Because, you know, let's say it's $1 million capital gain and almost all of it is covered by your lifetime capital gains exemption. It might be tax-free for regular taxes under the current AMT regime. 30% of that is included in your AMT income. That's going to be the same under the new AMT rules.
All right, I just want to say thank you to Canada Life for sponsoring this session and for sponsoring the whole event as our #1 diamond sponsor this year and last year. Thank you, Steve, for that. The technical ones is really where you get into the weeds, and not everyone can do it. So if you do have those questions, Steve will be here for a while.
Yeah, actually got to run off to do another presentation
Oh,
right now.
yeah.
But
Steve will not be here for a while,
I got a
but
couple more today.
all of the slides for all of these presentations are uploaded into Feedloop. It might be, you can download it from your app. You can download it on your computer. And if you're at home, you can download it. All of the presentations will be underneath in each session. You can go and click on that. So Steve, thank you so much for your presentation.
Yeah, thank you.
Thanks so much. And then if you're joining us at home, we started a little bit early. We will be extending this break a little bit. Our next session starts at 2:30. So you have about a 10-minute extra break, and take full advantage of that. I would say shake some hands, kiss some babies. Maybe you want to drink more coffee if you haven't already had 9 cups. I don't know if there's a limit for the day. And we will see you back at, give it 2:25 so that we can be on time for 2:30 and keep it moving. Thanks so much, guys. Oh, and before we go, don't forget, if you want to win a brand new suit, custom tailored suit from Indochino, you have until 3 o'clock to meet them in their booth. If you're joining us virtually, go to their booth through the virtual. And we also have another contest from Home Equity Bank, who is giving away a pair of Apple AirPods. So to do them, go to see Tim Whitaker at Home Equity Bank booth in the hallway there. If you're joining us at home, go through the Feedloop app, go to the Home Equity Bank, message Tim Whitaker with your email, phone number for a chance to win. That contest closes at 2:30. So during this break is the time where you can enter to win a pair of Apple AirPods from Home Equity Bank. Thank you so much.